Hi, I'm Patu from freefincal, and today let's talk about how investors get fooled into buying mutual fund by misleading ads, misleading promises, and their own laziness to actually read the fine print and understand what the ad is trying to say or convey, and whether the facts mentioned there are right or wrong. So a few days back, or maybe a couple of weeks back, I had mentioned about the ICICI Asset Allocator Fund. I had showed how when an AMC wants, it will drive up the expense ratio. It will promise distributors riches and drive sales into a particular fund. We looked at the fact sheets of ICICI mutual fund. We looked at the details for ICICI allocator fund. While I was searching for that details, I found the following image. This is actually slightly adapted. I'll show you the full image. I just um, shortened the image for better viewability. You can see here it shows a couple who are celebrating their 10th anniversary. Yeah, and the ad says, "Stay invested. Your mutual fund investments need time, just like your relationship." As if after 10 years there is happiness in a marriage. Remaining invested in equities have given up to 5x star, there's a star there, up to 5x growth over 10 years. Oh, 5x growth over 10 years. That's what most people will see. And there's a star there. That star says, based on an average of 10-year daily rolling returns, equity has grown over 5.4 times. So it's not just 5x, it's 5.4x. So that's wonderful, no? That's why we should invest in equity and so on. It's so easy to sell it. The problem is that people are being sold equity by saying over the long run everything will be okay. Over the long run everything will be okay. Invest, invest, invest. They are not being able to. They are not being told of the true risks. They are not being able to. They're not being educated about the true risk, and the fact is they don't want to be educated. I have been talking about risk for 7 years now. How many people take it seriously? They don't. They take it seriously when the market falls. When the market starts moving again, then they don't care. Okay, equity is risky, no? I know. That is the kind of attitude. So nobody wants to learn, and nobody with power and money is willing to educate them. This is the big problem, and they believe such things are. I mean, they're assumed to be possible. Nothing else can happen. That's the problem. So let's examine what are the numerous problems with this ad and why I believe they are being used to get money from investors, and investors get fooled. It's their fault. It's not the AMC's fault. Uh, Salesman will sell. Salesman will always say Aswathama is dead. When they star in the fine print, they will say, I don't know if there is an elephant or a person. So that is how all selling is done. Including physics. Take a look at Nat Geo videos, all these documentary videos. Look at the way they sell, how the scientists behave. Do you really think on a day-to-day basis, physics or any kind of science is so glamorous? People look at those videos and come join a PhD or come join a degree related to physics or want to take career as physics. But when they come in and understand how physics is done on a daily basis, many of them are disappointed. Many of them want to do something else. And they ask me, sir, you got interested in finance. I also want to be do something in finance. That's another matter. So this is the January 2016 fact sheet. This is a full page front cover, and it also tells you there's another bit of statement here. It says the data source is the S&P BSE Sensex from January 1st, 1990 to December 31st, 2015. And of course, it also gives you the past performance may not be sustained in future, and so on and so on and so on. So what is the problem with this ad? What is wrong with this ad? If you think something is not wrong with this ad at this point, you certainly need education. If you understand all the problems, or maybe because you've read the post before, I don't know, then congratulations. You cannot claim that over time everything will become all right in equity. That is the repeated claim they make every time in all these mutual funds, Sahi, I add on and so on. That is completely wrong. That's the first mistake. They are implying that over time everything will be all right. You have to stay invested. You have to give time. You are giving time to your relationship now. Then you should give time to your mutual fund. That kind of logic is illogical. But of course, for selling it, anything is okay. The data says up to 5x growth. Up to 5x growth means it can be less than that. This is a common standard. Up to 20% discount, up to 50% discount means whenever, if you go and buy, you will not get that 50% discount. It will be there only for certain conditions. You have to buy this certain amount, then you will get 50% discount, or certain products. So this up to nobody sees. Third, um, they are basing this 5x growth or 5.4x growth from average of daily rolling returns. How many people will know what is rolling returns, what is daily rolling returns, and whether you can take an average of the data or not. Now, first of all, if you look at the data, this is the rolling returns for the every possible 10-year period between whatever that those specific dates, 1990 to 2015. That just mentioned those dates. So between 1990 to 2015, if I take the 10-year data, 10-year return data points, there are 3,754 10-year data points. The white line is the Sensex TRI that I have generated by adding 2% return to the price index. The green line is the price index. I've added the Nifty total returns index, more recent data just as a benchmark. So the 2% is actually an overestimate, but look at the the variation in returns, 10-year returns possible, all the way from 26% to -2, -3% over 10 years. Anything is possible. There is absolutely no way you can take average. Just because it's a collection of numbers, you will take average, is it? Knowing the formula for taking average is information. Knowing when to take average is knowledge. Do you want information or knowledge? You decide. So it can just be anything, and there is no way you can. First of all, the average should not be taken. The average should not be trusted, and second of all, the average is actually much lower than what they are claiming. So taking an average, there's a very nice statement by Gregory Morris in his book Investing with a Trend. A 6-foot man drowned while trying to wade through a river that was only 3 foot on average. So somebody told the 6-footer guy, 6-footer, that this river on average has a depth of only 3 feet. So you can safely wade through it. What does it mean? You understand what I mean, right? It's average. If you search on Google, you will find images for this. On average, it is 3 feet, but that doesn't mean in certain places it can be 10 feet. But that's only one place, it's 10 feet. But that man could have stepped there and drowned. So that's how it is. So don't trust averages. Understand what is the data source, how is it calculated, whether an average makes sense. Never ever take average of rolling returns. I show rolling returns practically every day in my website and videos. Have you ever seen me take average of rolling returns? Because it's wrong. It's wrong. So you just cannot do that. Now, this 5x growth or 5.4x growth over 10 years means it is an annualized return of 18.4%. 18.4% as an average, they are saying, is the average of the rolling returns over that period. I get an average for the data, I get an average of only 14.7% for the Sensex. I don't understand how an average can be 18%. There's something fishy about this. I don't think, even if my data is wrong, I think that 18% is also wrong. So there are so many problems in the ad. But look how it's got so much of packaged fine print, and most of it is essentially faulty, wrong. And if you calculate the 10-year data all the way to August 2019, you can see that in the recent years it has even come down more. So you can see all the way, even as you can see here in 2008 or so, last 10-year returns was about bank FD, bank state SB account only. So Don't believe in all these averages. Understand the spread in returns possible. When you are looking at the spread in returns, you are focusing on the risk. Focus always on the risk. Don't blame the AMC or the advisors. That is their job. That is their livelihood. They're just doing their job. This is your money. This is your future. This is your life. You have to sit and research. Nobody wants to do any kind of research. They want returns without effort. How is it possible? It's just not going to happen. You're going to, if you want returns without knowledge, without portfolio management, without risk management, you're asking for trouble. See, don't say one video I am saying have hope and invest in equity. In another video I am saying don't get fooled by AMC. No, why are you taking extreme views like that? You can have faith in an asset class, but you must still back it up with knowledge, basics of what is happening, based for your personal situation. You can do both, and that's what I have always been saying. So please be aware of all these AMC ads. Don't let them fool you. If I mean that's their intent. They just want your money. So take care. I'll catch you again in another video.